Good morning, folks, and welcome to the pre-market insight for March 18th, 2020. We're met with another long limit gap down. Let's take a look at the charts. So we're taking a look at the the S&P 500 futures, and I'm zoomed out to the longer term chart, the weekly chart, and this is where we currently are in terms of the price action. And if you look immediately to your left, you can see this very prominent low that we have here that everyone is talking about, possibly anticipating us retesting this December 24th, Christmas Eve's low at 2316 before we had a V-shaped rally for the ensuing month and year. So we have now sold off and gapped down off of that juicy, just about almost 6% rally that we had yesterday. We sold all the way down and broken beneath it in pre-market trading. Actually, because of the lock limit down, we're locked at 23.93. Yesterday's low was a low of 23.52. However, if we take a look at the SPY instead, you can see that yesterday's low was made at around 237.07, and currently in the pre-market session we've traded as low as 235, and we're holding beneath that 237 low currently. That is going to be a very important reference point in the first 15 minutes, 30 minute, and 1 hour time frame to see if we can get above that 237 low that we made yesterday uh, on the SPY. On the ES, that would be the prominent low that we have at 2352 immediately to the left, and then the gap down low of 2350 for the week. And so if we cannot get above 2350 and begin to either build value at that level for a potential retest of the underside of this range here at 2373 or so, then we may be decidedly in store for a lot more downside. Again, the first level we have would be that very prominent 2316 level. If we break 2316, if we zoom back out all the way to the weekly chart, to the monthly chart, sorry, you can see that after this 2316 prominent low, because of the nature of the price action and price structure, we really do not have any significant, I would say, support until we get into these levels closer to 2200, which coincides with the former resistance possible level of interest turning into support on the downside, as buyers may show up aggressively there to defend the market at these levels, given the fact that that is going to take us to be just about 35% off of the most recent highs. Keep it simple, smarty. In this environment, if you are not prepared, if you do not, and this is where you have to be honest with yourself, if you do not have the skill set to be able to nimbly, quickly accept losses and or quickly take profits into weakness if you are short, or take profits into strength if you are long, then perhaps it is best that you just simply sit out and observe, because this sort of price action in this environment that we're in is without a doubt historic. It is not typical. It is the tail extreme in terms of the price action that a trader will ever experience and or investor will experience in their career, which makes it so ripe with opportunity, but also so fraught with risk. So if you cannot, or you do not have the skill set, you do not have the tools in your arsenal to navigate this, then perhaps you better sit it out and or only interact or engage with the market with capital that you can afford to lose, that you do not need. And then particularly in this economically sensitive time where there is a slowdown, businesses are not being patronized, consumer sentiment is low, and there may be a slow and protracted recovery, be very careful, be very mindful with your expenditure and the risk capital that you put into play. This is to by no means discouraging you from, if you do have the skill set, by all means, you need to be taking advantage of this price action and the volatility and increase returns that can be had as a result of it. But just a disclaimer for those who are not, stay in your own lane, observe the price action, and learn as much of it from it as you can. Keep it simple, smarty. Be safe out there today.